Just turning my display to 5 minutes so my timer doesn't go out. All right. So I'll stand up here for the moderator. Now, I know you've actually heard, who's heard from all the presenters so far today except for one? Okay, so what I'll do, because you guys have all presented, there's only one more person really to introduce that hasn't presented yet today. So Akshay, can you just give a bit of an introduction to yourself as a bit of a starting point?
Sure. Good afternoon, everyone. Thank you, Steve, for having me here. My name is Akshay, and I'm a founder of the firm Creek Partners. And Creek Partners is effectively a way to create a nexus between Australian wealth and the Indian VC ecosystem. We raise capital here and deploy into the various VC firms, domestic franchises who have exceptional track record, and we act as a fund of funds, but we actually execute as feeder funds. So that's a little bit about myself and Creek Partners. Thank you.
Perfect. Now, when we promise an alternative investment panel session, I think we really deliver. We've got Indian VC, we've got industrial property, we've got fintech payment solutions, we've got hotels, and then we've got defense tech. That's what I call alternative. Yeah, I know. I'm going to get roasted for that one. No one posts a photo of all of us on here on LinkedIn. All right. So just to kick off, Damien, you've obviously been a strong advocate for unlisted property as an investment class. What are some of the key advantages that you see over traditional real estate or even listed REITs for high net worths and family offices?
I think one of the key things is the stability of assuming it's a good quality asset. That's always the underlying criteria, of course, but it's the stability. As we see in the listed markets, the listed REITs tend to go sometimes plus or minus 30% over net tangible assets. So whereas unlisted, the valuations are done regularly and it's quite a much more stable asset. But you've got to be prepared to be the downside of it, of course, is you have to be prepared. You're locked in because it is unlisted. You can potentially get out if the firm can find other investors, but it's not as liquid as the stock market. So the trade-off is the positive is it's a more stable valuation, but the downside is it's less liquid.
And for you, Evan, mate, you're successful. Run your own family office. You got your own venture fund. You look at all sorts of stuff. You've got a helicopter view of the world. Why have you chosen payments as your area?
Thank you, Steve, and established panelists. What I would say is having my own family office as well as looking at different investment opportunities, one thing that we were looking at was what could mimic infrastructure-like returns, but yet provide the exponential growth of innovation and ongoing innovation. And there was really a few sectors that highlighted that capability. Payments was effectively that, and the reason why I highlight that is because there's not many businesses around the world that can mimic the cash flow that governments generate through tax. And if you think about payments, it's effectively a tax on GDP. Everything on your wallet that you use today will have a payments cost in it. So everything that you're using to pay today, a sense of that is probably coming over to our business as well. So that's one of the key reasons why we focused on payments.
It's been, 27 years since PayPal was introduced, and yet this is still an issue.
It is, and it's funny that because our chairman, John, he actually was tapped by the banks in Australia to defend against PayPal when they came into Australia. Successfully did that for the banks here. Yeah. So but basically, you can imagine the banks are desperate, saying, well, how do we replicate the innovations from PayPal, from all these other fintechs out there disrupting our core banking business? And that's what we do. So we believe the banks need to be the fintechs. They need to be distributing these trusted technologies into their ecosystem because they're the ones that are financially stable. They provide stability in a sea of change.
You can just see an immediate relationship between them and Alex Bank, can't you? All right. Now, William, obviously you're focused on investing into hotels. Now, hotels are sort of quite known to be cyclical, obviously. How have you sort of looked at that from your approach to an investment perspective, and how have you, I suppose, countered that in the way you think about it when you're making an investment?
So yeah, hotels are cyclical. Our perspective is that's why we take a global approach, right? So our view is hospitality is global, and so we want to build a platform that was didn't have a home bias, right? And My view is that if you approach the right type of organization that has a large enough sort of basis, you can deal with the cyclical nature of the asset class. And I actually want to second what you said, is most of these private assets are not necessarily volatile, they're just illiquid. So you need to know how to measure the return and what you need to price in for that illiquidity. And if you can do that properly, you can ensure that when you're in a down cycle, one, it's going to look a lot different because it's not going to waver as such. And a lot of money in the private market is actually made during these downturns, right? So I think you've got a correlation. You kind of have a little bit of non-correlation happening in the private side, where even if you're seeing a market downturn, for most organizations, especially that are taking equity positions in these deals, that's where a lot of the money is made. Once the cycle, goes through the trough and re-enters the upside.
And Steve, for you, you're probably one of the most renowned sort of you started career as an angel, like you built and sold your own business, started your career as an angel investor, then you launched 1013 to do syndicates, got an incredible success portfolio across the whole tech space, even include, I think, some medical device investments. And then all of a sudden you find yourself, not all of a sudden, but then you move your way into defense tech. From your perspective, why was that, from an investment thesis at a high level, why was that the place you landed where you feel this is where you can create most value for yourself, like for your own wealth, but also, for high net worths as well?
It's such an underloved sector. I think a lot of our profit and a lot of our returns will be driven on the buy side here. So not only is defence unloved because of various ESG hardware and other irrational issues, but I, as an investor, I love things that are irrationally unloved. So we take it one step further in our fund. We specialise in lethality and survivability. Don't like lethality, don't start wars, right? But the reality is we're about to get into a pretty hot period of history, and we're about to need a lot of articles in that space. Now, I'm a father of kids. I don't want any of this to happen, don't get me wrong. But there's an absolute investment opportunity. It's an unloved asset class. My job as an investor is really easy. I buy low and sell high. A lot happens between those two. Even a lot happens before the first one. But in essence, how do I get the lowest price possible for the best class of asset? I think we've got a great class of asset. It's a class of asset that defends our lifestyles and our way of life. And it's just irrationally unloved. And that's part. So in essence, we're an anti-ESG fund, to be quite honest.
Is there any journalists in the room? They can just take away that headline.
I can give you more. I can give you more headlines if you want.
You do that quite well. And Akshay, for you, like I've been blown away by what India has achieved over the last sort of 5 years. It's so beautiful. Like you think about Dubai as an example where they've got their sort of, here's our direction, here's where we're going. India really sort of sets yourself apart where, effectively there's the 2030 vision. How does that rising tide lift all boats, specifically in the startup and VC space from your perspective?
That's a really interesting question. Thank you, Steve. I think the thing that is sort of propelling it is all the groundwork that was already done in early 2013, I would say. There are two things that sort of coincided that's kind of propelling the growth. The first was the expansion of the Silicon Valley franchises, so your Sequoias and others who were globally trying to expand. And of course, the Silicon Valley connection with India as well. 1 out of every 4 startup founders in the Silicon Valley is of Indian origin. A lot of the major sort of technology companies also have Indians as CEOs, your Alphabets, Microsoft, Palo Alto Networks, and so forth. So that kind of happened around 2012, 2013. The second thing that also happened was consistency in policy. So the Indian government has set in motion a range of initiatives to ensure that investment is the climate is conducive for innovation and investment. Multiple examples, the change in GST, the digital stack, the cost of data right now is about 15 cents. For 1 GB, it's about $3 here in Australia. So it gives you a sense of how much digital adoption is actually happening in India. So all of these preparatory work has gone into place and therefore has set in motion what we are witnessing now in the VC ecosystem. There's about 150,000 registered startups expected to grow at 30%. The total number of IPs that were granted in India last year alone was 100,000, and the current GDP is around 3.8 trillion, expected to touch 7 trillion by 2030. So all we're trying to do is find the companies that are performing slightly better than the others to kind of, generate that alpha that you're looking for. Hence, the rising tide lifts all boats in India. And really, it's a once in a generational opportunity. There aren't that many large economies that are growing at 6-7%, and so that's where we're finding that there's going to be a lot of opportunity we want to capitalize on.
Brilliant. And Damien, for you, like I think this would have been such an interesting period for you, just being sort of in the property space, and obviously just seeing the absolute sort of boom in private credit over the last couple of years. What have you noticed has been the change of investors as it sort of moved into a higher interest rate sort of environment? How has their sort of preference changed when they're having conversations with you about what they're actually looking to invest into? And then how does that ultimately impact the sort of assets that you're looking to acquire?
It was quite interesting, Steve, when everything is really priced off the risk-free rate, which is the government bond, and of course we had a government bonds short-term in Australia below 1%, and the Reserve Bank cash rate was 0.1%. So when you could investors with real estate, when you could get at them perhaps 7 or 8% yield, they were flocking to that, plus potential capital growth on top of that as well. When the market turned and interest rates went up, and people could get 4 or 5% on term deposits, and credit funds are offering 10%, in some cases more, there was certainly a sentiment shift towards that. But we've really noticed in the last 3 to 4 months particularly, people are realising as much as private credit's great, you don't get capital growth on private credit. It's a fixed return, not guaranteed either. Of course, it depends what they're investing underlying loans are. We're certainly starting to shift back to real estate. People going, well, yes, my term deposit is coming off, and that's going to continue to come off as rates come down. So there is starting to see some money starting to shift back into real estate. I think it'll come in a bigger wave, certainly the second half of this year, if the forecasts are correct, and we do see those rates continue to go down. So it's a market that's very sensitive to interest rates, but certainly we've been buying assets, and I think there's good opportunities in the next 6 months before the really big wave of money comes in 2026 to pick up some really great assets.
Brilliant. And Evan, for you, like what I found really interesting about our sort of first conversation was you sort of gave me a bit of insight to how archaic some of the existing banks' infrastructure is. So I thought two things that would be great to do is to, one, give a bit of a highlight as to what that looks like now for some of the existing banks. Like what is their architecture, their software structure, their processes look like? And then a bit of perspective as far as how you see what does that future, what does the future look like from a payments perspective, and also how does that make it much more easier from a global transaction perspective?
Thanks for that. That's a complex question. Every single bank in different countries will have a different architectural setup. But you can imagine there are banks out there that are using technologies from the 70s and 80s still. There are tape drives still being used. So you can imagine
Do they have any bunkers that they take them down to?
Like tickets, right? So you can imagine the challenges that one faces when they say from the business unit, how do we enable this new cloud-based digital payment acceptance capability? And then yet you go to their core banking systems, you're like, oh, wow, this doesn't communicate. You need it to communicate by telephone line. So it's a very interesting challenge set. Now that evolved over the years to where banks then owned the hardware, owned the software, developed everything internally, but that was monolithic and it wasn't conducive to innovation and to meeting the market needs. Fast forward, then the cloud came about, then the banks were exploring, well, how do we better utilize our resources in the cloud? So this is where kind of we stepped in and said, well, you know what, bank, that's a massive infrastructure investment, and you're not experts in that area. So let us take hold of that. We will run your bank infrastructure outside of what you're used to. But in the same instance, you have all the intelligence and feedback from your business community, your consumers, about what you need. And then effectively, in the old days, they would say, well, how much is the CapEx going to cost? Yeah. What's the business case? Are we going to do this investment and reach out? We simply say, don't worry, bank, we'll take the CapEx cost. We'll even take the innovation risk because the IP stays with us, but let's share the love. We're going to help you grow revenue, bank. And that's really gotten the banks super excited about de-risking this change, because before these technology update processes might be every 8 years. and then it went every 5 years. Now you're talking about every 3 months, you've got innovations coming out. Banks cannot keep up because it's such a highly regulated environment. So one of the questions I receive a lot is, why don't banks use AI more? Well, the problem with deploying AI within bank systems is because everybody wants to hack in. Everybody wants access to your bank account. They want your funds. So you cannot develop it without understanding the security architecture and how everything impacts the whole ecosystem. We can use AI to assist, but then at the end of the day, our security experts need to go through and ensure that it's impenetrable. And that's the challenges, and that's why banks have moved so slow. So we've been able to bifurcate core banking with modular capabilities, do all the stuff and keep the risk out, but then when it comes into the bank, when real money touches, risk has been removed from the entire technology ecosystem.
So to summarize it, you allowed bank CEOs to promise innovation with no CapEx cost.
Exactly.
Nice.
Exactly.
And-
that's why they love it.
I know, it's perfect. Because I just to be blunt, I know that that's actually one of the issues is obviously CEOs are performance managed and their options are tied to profitability. So they'll often not actually go invest in what they need to inside the bank because of that as an issue, because it would actually impact their own outcomes.
Exactly. So, and interestingly enough, the current kind of incumbents, the bosses of the divisions, they're typically usually the blockers to this kind of change. So if you focus on the second tier, the up-and-coming superstar that wants to show change, they typically make the biggest impact because once they come in, they can immediately show, look at this board, I've saved 50% costs on our technology. I've increased the revenue by 200%. Why? Because they partnered with BankStack, right? So that's kind of how we've positioned the solution to banks.
Brilliant. And William, for you, like I remember you did a post on LinkedIn where you sort of introduced this concept of quantum mental analysis. And I was already impressed by what you've done in your background, your experience as far as building, sort of selling companies and then sort of moving into this area. And also just the sort of doing global hotel deals. Just give some insight for investors about how they can think from a, if they're thinking about alternatives, if they're thinking about sort of generating yield for themselves in sort of hotels, how you blend the sort of quantitative models and also the fundamental insights, when you're sort of assessing opportunities and why that gives you an edge.
Sure. So quantamental, you know what it means is quant and then fundamental. So the fundamental is who are the operators that I'm working with. So I actually want to second what you said. Like if you're not investing in
I think they're
India-
becoming friends really quickly.
Yeah, no, my Indian friend here. No, if you're not investing in India, you need to be investing in India. That said, that's what the data says, right? There's no country as large, it's the largest country in the world, large population, largest land mass, fastest growing
Modi,
country.
king deal maker.
Yeah. I mean, youngest population. It's really a Cambrian moment. It's not just like this is a once in a lifetime sort of thing to be making money in India. That said, operator risk is a very real thing. Like, who are you working with in India? You touched on the technology, but like I don't think people really comprehend like what you mean when you say they have one portal where foreign direct investors are able to come in and actually do the types of procurement that we're familiar with in a country that's so large. It's actually easier to operate in the country there than some of the smaller countries that I think a lot of people are deploying capital. And the interesting thing is a lot of institutions don't touch India. Like, I brought the Indian government over to the city of New York, one of the largest pensions in the US, and the government basically said, look, we're not going to let any of these deals go bad because we have 0 US institutions that are allocating money to our country. So there's $0 going in. We met with CalPERS, City of New York, State of Arizona, like all these big pension plans. And I was shocked that the response was, we can't invest in India because we don't have any consultants in India. So even looking at the data and seeing the fundamental operators that they have as a partner, a lot of people are still going to hit their heads in the sand and say, well, it's not something I understand how to do, right? And so when you take a quantamental approach, yes, you need to have the data, but you need to also understand like who are the operators that I'm working with. And if I have strong government partners like Startup India, for example, which is run by the group that does Invest India, Nivruti Sai, the lady that runs that, she was CEO of Intel India for like 20 years. And our largest investor, past CEO at Intel, Sanjay Poonen was the COO at VMware. And these are some of our largest investors in the fund. So where other people have a difficult time deploying capital in these regions because of the risks that are there, if you take that data-driven approach and you have a fundamental understanding of the teams that you're working with, you can diversify out a lot of the poor experiences that people have had. So that's sort of the idea behind, taking a quantum mental approach as opposed to just doing, pure algorithmic trading or just pure relationship based. Oh, this guy's cool. Like, I was introduced to him by someone I like, so I'm going to invest in them, you see.
Brilliant. And Steve, for you, I suppose this is a question just regarding sort of innovation in defense tech, but when you sort of did your research on this as an area, when you were sort of doing a deep dive and thinking about your fund, what did you sort of observe about the role that innovation played in the outcomes of wars and, just in the way in which I suppose the world has been shaped?
Well, there's no one more innovative than a young soldier being shot at. So, it does spur a fair bit of activity. I'll give you a more modern example rather than, innovation's moved that far in the almost 3 years since I started. It's almost not worth talking about. In the last couple of months, there's been an amazing revelation around what the Ukrainian government have done around what's called the Brave One portal. Just bear with me 1 second here. But there's a book called the Clue Train Manifesto, released in 1999. It's all about markets or a series of conversations, essentially. And if you're not online talking to your customers, they're talking about you behind your back. So wake up and get online. Very much a 25-year-old tome on business at the time. Well, the Clue Train Manifesto just met war. So the Ukrainian government have basically taken their online portals. They've taken their ability to deliver technology to frontline units fighting the Russian army to a web portal that looks like Amazon Web Services. Western countries get to put their Western companies, any company gets to put their gear online and units get to buy it in an open marketplace. They get to give it feedback about how it fared in combat through a star rating service. They get to suggest modifications and adaptations back to that same equipment. So all of a sudden, we're in the West, we're doing innovation cycles measured in years, which is down from, decades, to be quite blunt. You're now getting basically weeks between innovation cycles. So this whole online business that you're getting, that you're closing the feedback loop, you're getting the whole hyperlinking. In the Clue Train Manifesto, they talk about that mass media has been defeated by hyperlinking, essentially. So you're seeing that now in combat. So it's coming full circle. And I find that just fascinating. I'm trying to write an article and I'm trying to wrap my brain around it, to be honest, because you are now seeing you're seeing combat innovations in the Ukrainian side, for example, where they used to create some whiz-bang new thing, probably a drone variant. They used to test it on a certain part of the front line. The Russians learnt that fast, they'd adapt across the rest of the front line. So now when they get a combat innovation, they wait, deploy across their entire front, then launch it. So now they've got 7 to 10 days before that's been counted. Now that's mad. We as Western nations are still releasing tenders measured in years to get combat innovation. Please talk to your federal members. That's crazy, but like I said, there's no one more innovative out there than someone being shot at.
How's something like like Anduril's, I suppose, the example where their founder went from being the outcast of Silicon Valley to now, a respected sort of voice, on defense tech, and just going from a startup to a multi-billion-dollar company, winning government contracts, and also displacing some of the existing sort of suppliers, to defense. How has someone like them sort of helped create, I suppose, the new era of sort of startups in defense tech?
Oh, they've done well. They're not the first, so I think the first would have been Palantir, to be honest. I mean, all the pioneers who took the arrows were Palantir, probably SpaceX. Then you had Anduril is probably the more recent one. That there are others out there as well. So and they've pretty much now Anduril especially have brought a Silicon Valley approach into defence capability and services and products and defence are called capability. It's a stupid term. That's what they use. In that they've built products first. They have found the demand. They've then built the product and then tried to sell it in, as opposed to convincing the government they need to release a tender to get to this process. So they've end run that. So it's a lot shorter there. Anduril now built everything from border post sentry monitoring devices through to missiles, drones, underwater torpedoes, basically small aircraft, the whole thing. And they're doing this at the speed of Silicon Valley. I feel Raytheon and Northrop, they're on the block. So, because things are about to change. I mean, the Ukrainians defeated the entire Russian Black Sea fleet without possessing a single boat larger than probably a Manly ferry. Probably even not even that size, probably the lifeboat for Manly Ferry, to be honest. So they're all unmanned, automated boats, very cheap, lots of them. They only work 85% of the time, but they cost 100th of much. So there's 100 times as many of them. So we're not learning. And the opportunity for investors is the fact that we've got to replace all these big, expensive toys the military was buying with the cheaper, more plentiful, more commoditized, software-driven to a large degree tools out there. They only work 85% of the time, not 93% of the time, but they literally a 20th to 100th of the cost. And that's the new equation. It's cheap, it's lots, it's mass. It's called attritable mass. You don't mind losing the things that only cost you 100 to the other thing. So you just send 100 times as many.
I remember one of the stories during the Iraq War where Halliburton, if they had a truck that blew a tire on a trip, they would literally just leave the truck.
Well, that's just Americans in general. I mean, you want to see people, flagrant with capital, just go to an American military base. Holy shit. Excuse me. So no, that's just not Halliburton. That's just Yanks.
So over to you, Akshay. Just a question for investors, sort of used to Western markets and, I suppose used to our sort of, what is some of the nuances when it comes to Indian, to sort of dealing in India and sort of Indian VC and just the sort of startup ecosystem?
Look, it depends on where you're investing. I think there's, even within the VC, I think there's a distinction between early stage and growth. So I'll address the early stage. So if you're planning to invest in, a seed stage ideas, then I think the first component is cultural, because a lot of the entrepreneurs in India, they're not looking to buy a penthouse in Mumbai. They want to create jobs. It's more about they have a socialist bent of mind, and that's just a cultural thing. So whenever you engage with them, that kind of tone is a little bit different. The second thing is sourcing is really hard because, as I said, the system that is now in place, which I believe is the third iteration of the VC industry, so there's been a maturation of the founders themselves. They've exited multiple businesses. So if you're trying to source deals, then there's already a queue of people who are waiting to kind of invest. The third thing is that entrepreneurs already understand that capital is commoditized because capital is freely available. I think the other thing is that what sort of adjacencies are you able to bring to the table? So they are beginning to ask these sorts of questions. So if you're planning to invest, then you should be able to answer those questions. With respect to the growth side, again, there's a lot of opportunities for secondary funds right now to provide liquidity, because this is the first time in the history, I believe, the whole end-to-end VC ecosystem is available, right from early stage to growth to pre-IPO, private equity, and also onto listing. So I believe there's a nice sort of secondary market, and we already have the likes of Hamilton Lanes and so forth who are sort of playing in that space right now. I think that if you want to invest in growth stage, and you're looking for co-investment, as long as it is a positive selection criteria, good for you. But if you're just trying to deploy capital at a lower cost base, then that's not necessarily a positive. It is a neutral selection criteria. Yes, you want to deploy capital at a fairly lower cost, but just so that you're able to identify the right opportunities and you're getting the right kind of return profile. So those should be sort of your governing decisions as you're trying to invest in these stages.
Fantastic. Now we're almost out of time, so I always love to finish with this as a final question. This is for each of you to answer. We'll start with you, Damien. I'd just love to understand your perspective on how you see your own thesis for how you see the various spaces that you're involved in playing out over the next 5 years. And I ask that from the investor's perspective, seeing in the room that, if you want to leave something in their brain as to how to think about things in the next 5 years for the space that you're focused on, what should they be looking at?
Well, certainly in real estate, the revolution to online ordering and deliveries, I think we're still in the early phases of it, and we're a long way behind the US. They are already at 22% of all product retailers now home delivered, and that's getting now, they're expecting it to get to 35-40%. So Amazon and bringing in same-day delivery around Australia, that's been commonplace in the US now for 6-7 years. So the thesis on industrial and logistics is still there. There's still very strong demand for that type of property. And the other one is the neighbourhood centre, though. The neighbourhood centre and the large format retail centres, they've all discovered that sounds very good to have a warehouse out in suburban Sydney, but it's a long way to go from there right up to the North Shore and the congestion. So it dovetailed in with logistics and bigger sheds is also the fact that the neighbourhood shopping centre, like the supermarkets, that's where you're always going to get your groceries from. You're going to click and collect is what they want. Same with the large format retail. They're very low cost. The percentage of turnover is quite low because you've basically got a retail centre, open car parking. People can come right up to the door. I think the days of going to big shopping malls is going to continue to decline. They're trying to get people in there with entertainment and so forth, but I think long run they're on the nose and they're going to be very expensive to run. So the model of retail is changing. A lot more home delivery, but also for the retailers who are using their large format retail and neighbourhood centres as their distribution centres. We're not in the office space. There will be a time to come in the office space, but I still think the work from home, the downsizing effectively of office sizes, people realising they can do maybe 200 people in a 150 office desk just because people are working from home. I still think that's got time to work through. We would buy a really good deal office, but I still think if it had a longer lease, that would get us through the next 3 to 4 years of pain. But I still think the office sector is got some pain to go through.
This may be out of your wheelhouse, but do you factor in anything around sort of autonomous cyber taxis or robo taxis as far as you're thinking yet?
Yeah, look, they've got them in the US. I know when I was in the US
China.
last year, the guy gets, I've forgotten the name of the company, but he gets a driverless car to the airport when he goes travelling. So look, yeah, that's definitely going to make distribution more easy, but at the same time, I guess there's a lot of regulatory hurdles to get through that. To get that into even in the US, it's only in some locations. In the long run, yes, we will start to see more of that autonomous distribution. It's actually not necessarily the truck driving up; it's how do they get it out of the truck or out of the van. And that's the hard part for them. It's like when I went and did a tour of our Amazon facility. The internal packaging was unbelievable, but it was still manually getting the goods off the truck at one end, putting on the conveyor system to distribute it, and then they'll repack it at the other end with manual labour. So there are still some things to get through before we will have completely autonomous home delivery.
I'm sure Elon's working on that with Optimus. And you, Evan?
With my investor hat on, where do I see payments and technology going in the next few years? Payment infrastructure will always be a thing. However, the interaction from the consumer and businesses and banks, that is what will evolve. So how you guys are using your phones and your wallets and your credit cards today, in 5 years' time, you're just going to pick up your assistant. Hey, Sam. Book me a flight to the Philippines. I want a hotel at the Hilton. And by the way, reserve me a dinner at a 4-star Michelin restaurant and get me a taxi, please. Agentic AI comes in, does that whole process for you, takes care of the payments in the background. You get your itinerary sent to you. Boom, it's done. So the interaction, the payments function will always still be there, but the interaction is what enhances. So what we're ensuring is that we're building a robust infrastructure that will last the ages, and that ensures that, and the reason why it lasts the ages is because security will be robust, but the interaction within that ecosystem is what will effectively push and help banks transition towards.
Brilliant.
Yeah, I think I'll push that even further. I think AI will actually it'll tell you you're going to the Philippines and you're going to stay at this hotel because it knows what you're going to like, right? You're not even have to do that. I think private markets in general, not just hospitality, but everything up here. I made the majority of my cess was public markets, so we use a Bloomberg terminal. Yeah, I think that the public markets are entering like this Bloomberg era, where instead of paying for a lot of external data that's unstructured and not really being able to make actionable decisions on it, every manager up here in the next couple of years is going to have something similar to what we shared earlier, which is a terminal that is allowing them to make data-driven decisions with some level of statistical significance, right? Because with what's happening in the AI space, you can take a lot of unstructured data, and you can take a lot of structured data, and you can take a lot of macro and micro data, and you can start making actual decisions with a certain level of certainty and clarity that you just couldn't do, 2 or 3 years ago. So I think that, the type of public data that we have to make decisions is going to sort of proliferate into the private markets.
And so that's one perspective on how you'd make decisions as a manager. What would you think if you're thinking about sort of how you envision changes in the hospitality area over the next 3 to 5 years. Like I've started to notice, some going to some hotels, there's no one to, you do self check-in, as an example. What are some of the other trends that sort of been observed that you're likely to see play out across the next 3 to 5 years globally?
Yeah. So it's payments. OTAs at the moment take a lot of money. So the Booking.coms, the Expedias.coms, Priceline, all of that. There was just a recent ruling passed a couple of days ago where Europe said that they have to stop charging the hotel operators so much. I think OTAs are ripe for disruption. I also think that the rewards for hotels are ripe for disruption. We haven't seen it happen yet, but I think with a lot of the decentralization that's out there and the ability for someone to decide how they're going to disrupt this rewards program, I think that'd be interesting. One of the gentlemen that we brought out here, Tommy, I wish he was in here right now. I'd actually let him answer it. But he's working with a group out of China that have 100 million members in their rewards program. It's mind-boggling, how many members do they have? And they have 500 keys, but it's all isolated in China, right? So again, I think what organizations like this are doing is saying, how can I diversify out of a region that I'm in? How can I take advantage of this massive membership base that I have, and how can I do that in a very efficient manner? And again, I think with AI, you can get some very unique approaches to solving for this. And as I mentioned, it's this sort of the world is your oyster if your platform is large enough to take on the risk of going into a new market and looking at the incentives that are in place to de-risk leaving sort of your home country where you've made the majority of your money. And most of these operators that are doing that are going asset light. So they're not putting a lot of capital in on the front end. They're just paying to operate the asset that's already there to test the brand in these new markets to see, does it make sense to continue to expand? So that's typically what you see.
I was going to say one other one I noticed is that I stay at a Citizen M hotel in.
Yeah, they just sold to Marriott.
Yeah, and it's super interesting how they're actually they've effectively turned the sort of lobby area into a co-working space.
Right.
And they have memberships for people because they realize a lot of their people sort of come in from out of town. They spend 1 to 2 days a week at work, so they'll stay overnight. So they've converted that in there. And I found that really interesting, right? Converting what was typically a hotel also into, office revenue effectively, and and obviously food and beverage with that.
Yeah, and I think consolidation's a real thing. Like Citizen M sold, they have 35 hotels. When Aloft sold to Marriott also, they only have 14 hotels. When Dream Hotel sold to Hyatt, they also only had about 10 hotels at the time. Graduate Hotels just sold to, so there's going to be a lot of consolidation happening in the space. And again, our desire is to get into those organizations before they take a larger exit and show them a compelling reason why they should take said, capital from us.
Great. And Steve, you?
My thoughts are far less deep and far darker. Well, we live in a world where our region's biggest tyrant's promised he's going to invade a small island democracy of 27 million people by 2027. It's a pretty unfortunate world, right? So I struggle to find. I look through. I'm a hammer and everything's a nail. I look through the military lens. And in since February 2022, estimates are between 4 and 10,000 Russian tanks have been destroyed with things you can buy from Dick Smith. All right, Russia now has no tank made after 1987 left in its inventory, from things we made from Dick Smith. When you think about that innovation cycle, how fast that goes, and I mentioned before when I was talking up on stage about the confounding factor of AI for being an investor. If you're improving business outcomes at 6% a month or 12% a month, that's a lot of change in that cycle, and so you can be really, really confident with your capital where you're going to put it at that point in time. All I know is in the next 5 years, we're going from $1.7 trillion in the allied world to probably $3.5 trillion in the allied world, and I want to sell before it tips over the top. I'm out to make money for investors, and the defence asset class is the way to do it.
Thanks, Steve. And Akshay, final comments from you. Next 5 years, Indian VC market hitting 2030 and their ambitions. How do you see? What do you see as your world lens?
I think I'll just say two objectives that I would love for us to achieve the firm. One is that I would love for Australian wealth to benefit disproportionately from India's growth, competing against all the other sort of sovereign funds and countries that are already investing. So I think that's one thing, because right now Australian wealth is very underrepresented in Indian innovation, and it really breaks my heart. And as an Indian immigrant, it kind of changes the weight of the debate for me. I have a child who's born here. She's an Australian, so that really gets me thinking and gives you a sense of what motivates me. The other thing is, it's a two-way street. If there's something that we can do to really make it a strong economic corridor between Australia and India, so have Australian capital acquire assets over here in Australia, or transfer of technology between both countries. And if we have done some small part to contribute to that seamless exchange of information and capital, I think I would be a really, really happy man in 5 years.
And I'll just add to that, I've been surprised about how many Australian founders are actually building businesses in India. Well, they're founders here, but they've actually got significant teams in India, and all their operations are in India, but they're founders here, firstly. Secondly, I've been surprised how many Indian investment groups have, and it's not your sort of typical VC, but how much Indian investment has gone into Australian startups. One of the areas that comes to mind is sort of medical device, specifically like in the heart area. That's been interesting for me to discover. Because so I don't think people would know a lot about this, as a connection. And it's good to see Irfan here. I know he's done a lot of work between building that bridge, between Australia and India. And obviously we're super excited to partner with you to actually help, escalate that as an opportunity and provide that pathway. And then likewise from your side, I love that you sort of think about it like that. So, ladies and gentlemen, we have successfully navigated the Alternative Investment Trends panel. As I said, we combined Indian VC investments, industrial property, fintech, hospitality, and defense tech all in one panel session. So that concludes. Please give a round of applause to the panelists. And on that note, we conclude Private Capital 2025. I'd love to say a big thank you to all of you that came today. Today's been a big day. Once again, I just want to say a big thank you to the Wholesale Investor team. I started that saying today, we have done a hell of a lot in this last month. I know most of you may have seen us at Emergence last year, but to pull off 3 different conferences between London, Dubai, then here, and also a 2-day workshop over the weekend, and also an office move. Miraculous feat for a small team. So thank you to the WI team. Ladies and gentlemen, enjoy your afternoon.